techniques and strategies that Barry has is hands down some of the best in the industry.
This morning, I cited Barry Habib, who's had an outstanding record as the mortgage interest rate follower.
I'll tell you something, I'm not too good to wash my hands. I try and learn every single day.
That's a big number. That's the number that Barry Habib called for and all of Art Cashin's followers have been looking for quite a while. See if it holds. That's a big deal today.
Who, though, would have predicted our 10-year yield would have fallen below 0.5%? Last Thursday, the Clayman Countdown brought in mortgage expert Barry Habib. Hope you guys were watching, because here's what he said.
I think the bond market in the 10-year goes to about 0.5%. Very realistic, in my opinion.
Boy, was he right.
And this man knows more about real estate, markets, interest rates. If you want to be prepared for what's coming.
All right, guys, so listen, where are things going? Where are we headed?
Do you know what motivates you? Do you know what motivates the people around you?
Well, welcome everybody. I am Bill Hitchcock, Senior Vice President of Business Development here at Atlantic Bay Mortgage Group, and we are super excited to have you here joining us and to have Barry here. Barry's like family, so we've done his bio, we've introed him a number of times. He's been here to our headquarters a number of times, and I think that video, you just can't do a better job than introducing him. And my favorite part of it, Barry, is when you're walking behind stage, and it's look like you're coming out for like a heavyweight championship fight. So there's like so much energy there. We are really excited. Engaged Speaker Series is just something that we try to offer to the community, to bring in different speakers, bring in different talent, and just provide information to the public. So hopefully you continue to follow us, and also you can check us out on our Lending Forward podcast as well. Again, just trying to make sure that we're providing information to the industry just like Barry does. So we're super excited to have him here, and my co-host today, Miss Emily Gardner, who is our Chief Lending Officer here at Atlantic Bay. So welcome, Emily, as well. We're excited to have you here also.
Well, thank you, Bill. And Barry, we're really excited. We know you've had a lot going on personally and a lot going on in the industry. And we cannot thank you enough for your partnership over the years and your team. They are just amazing. And it's our pleasure to be able to share you with our internal Atlantic Bay team members and our external ones today with all of your great knowledge, especially right now in an industry that is ever evolving and changing, and your insights are spot on. So thanks for being here.
Oh, it's absolutely a pleasure. Bill, you're right. We are family, and I love you guys. You guys are very, very dear to me. I admire Atlantic Bay, and I'm so glad that we're going to spend some time together here. Got a lot to cover and a lot to go over. The guy that you saw in the video in the last couple of months, there's been a little bit of a transformation in the way I look. You might have noticed that. That's because I'm battling cancer. I was diagnosed with cancer, and I'm going through some pretty rigorous chemotherapy treatments. There's 6 rounds. I've done 4 of them. I actually had a PET CT today. Hopefully we'll find out we're making some progress there. So, it's been a battle of overcoming adversities. And that's what I wanted to kind of talk with you about, because we all are facing and overcoming adversity in our life, whether it be personal, kind of like what many of us are facing, certainly what I'm facing right now, business, which has been challenging. There are adversities that we are up against. So today we're going to talk about how to view those and how to overcome them, how we can, through our understanding of what we're facing, as well as our mindset, really can help us get through times, whatever they are. And you have to excuse me, because you could probably tell my voice, it's just not there. It's not that I'm hoarse or anything. It's just that's what the chemo does to you. So God willing, that'll all come back, once this is done. But forgive me for a little bit of raspiness in the sound of my voice. So team, I'm going to pull up some slides here, and we're going to get right to overcoming adversity. We're also going to take a look at the Fed, interest rates, housing, and where we go from here. So first off, things can always be better, and we want them to always be better, right? But I can tell you that as we may have all discovered, and certainly as I discovered, things can get a lot worse in a moment's notice. Being diagnosed with a very a very serious form of cancer. On Valentine's Day was the day I received my diagnosis, with a large diffuse B-cell lymphoma. It's called a double hit lymphoma. And, untreated, the survival rate is less than a year, but we are going through some very rigorous chemotherapy. And it requires, as I mentioned, 6 rounds. I've done 4 of them, but the rounds are, you have to have 5 days of constant infusion where you're actually hooked up to this pretty big bag and a pump. And you go through this port that I had to have surgery for. And you've got 5 days of that, which is tough and uncomfortable. And it's difficult even afterwards, that period afterwards. And then you get kind of a good week in between, and you get 3 weeks between each treatment. And then you kind of start the process again. But even though that was not great, I'm very grateful. I'm actually thankful for many reasons. Number one, that we found it. And number two is that because that was by accident. And I'm also grateful that I'm able to do the treatments outpatient, because the first thing that I had been told was at the Cleveland Clinic. They said, you got to be in the hospital for these infusions. So just do the math, 6 rounds, 5 days, 30 days in the hospital. I go nuts if I'm 1 day in the hospital. And so the fact that I found a center in New Jersey that allows me to, although it's very inconvenient, to at least go home, sleep in my own bed, be productive, go out, I'm grateful for that. And that's one of the things that is really important. That's kind of like mindset is such an important thing. I've always said that, but now I'm kind of living through it. And I have a very grateful mindset. And one of the things that I do, that I practice, I've always practiced this, and I've kind of talked with you guys about this in the past, and I've shared this with you. It's in my book too, is that I literally start every day saying out loud all of the things that I'm grateful for. Today, one of the things I'm grateful for was you folks, and spending time with you and having this opportunity to be with you. I get my mind right in the morning. I usually have a little coffee, then I kind of talk to myself and say out loud all these amazing, wonderful gifts that I have, how blessed and lucky and fortunate I am. This is a dream. And that helps, because invariably, even if it's something minor, somebody's going to disappoint you, upset you, somebody will cut you off, and we're human. So it's okay to have a moment to be human and be a little upset about it. But then it's great to reflect on all of the wonderful things that we all have and get your mind straight and not allow these disappointments to steal your joy. And that's the key, because, whatever time we have, whatever we're here, you want to live in a joyous state. You want to be happy. That's the goal for all of us, right? We want to try to be happy, to enjoy this time that we have. And if we're upset about everything and forget about all the things that we're grateful for, it makes it so that we're spending our time in not the best place to be. And I think that's where a lot of people go wrong. And then there's the fact that you're unable to bring joy to others. See, when we're upset, that energy, we're unable to bring joy to people. And one of the best things that makes us happy is bringing joy to others. Clearly, look, we want to make sure that what we do is successful financially, successful goal-wise. And we want to set those goals. We want to achieve those goals. But how many times you see people that are very financially well off and they've achieved so much, but yet they don't appear happy. And I think it's because they are lacking a very important element, and that's fulfillment. And I believe that fulfillment comes from doing good for others, bringing joy to others, and being in the service of others. And for that, we need to be in a grateful mindset so that we could do that. So if selfishly, being in a grateful mindset allows you to bring joy to others, and selfishly bringing joy to others will make you happier, even as you're going through your own difficulties. I grew up very, very poor. And my parents were immigrants. They didn't speak the language. My dad passed away when I was a young boy. And I remember, we're growing up in Brooklyn, New York is where I grew up in New York City. I was a city kid. We would ride the subways, and I'd be with my mom. And again, we were very poor. She didn't have anything. But if she saw someone who had even less, I remember she'd take out this little change purse, as well, had some sequins on it. I remember it vividly. And even though we didn't have anything, she would just give to help somebody else who was even more in need. And she would turn to me as a little kid, a little young boy, and she would say, it's good to help others. She says, God watches you. And it just struck me as such a lesson because I actually felt really good. You see, it doesn't take wealth to be rich. Rich is a feeling. And knowing that you're doing good and helping others, yeah, that's a feeling. So it starts with gratitude. But then what it also allows you to do, it allows you to see opportunities. And even in times like this, where we're having some struggles right now within the real estate industry, certainly the media is not on our side, telling everybody you should rent and not buy a home, saying it's the worst time to buy. Mortgage rates not being as cooperative as we like, certainly. Volume levels are down. If we are able to be in a grateful mindset, we could see that there's actually lots of opportunities right now. I'm going to talk with you about that. And that was one of the reasons I wrote the book, Money in the Streets. It's because when I was a kid, my mom would tell me stories about how, and if you are foreign born here, or if you're come from descendants of people that are foreign born, you know the story. They talk about America as such a wealthy country that there's money in the streets. All you got to do is pick it up. It's so rich, right? And my mom would kind of tell me, she says, oh boy, we thought there was going to be money in the streets, but then we came here, we didn't realize that it was not exactly that the streets were littered with $100 bills. It was a struggle. But before my mom passed away, I was able to sit and talk with her and tell her, I said, Mom, you know what? You were right. You know what? There really is money in the streets. It's just not in dollars. It's an opportunity. But for that, we need to see it, and we need to pick up those opportunities and do good with it. And that's the real money in the streets. And it exists right now. It exists especially in tough times. This is where opportunities are created. So let's think about what opportunities are out there right now. So there's a lot of them still, even though volume levels are down, 398,000 real estate sales a month, that's expected to rise. Now, if you're on the real estate side, that means you have a lot of opportunities every month. On the mortgage side, 72% of those need a mortgage. So that's 286,000 transactions. And you know what? There is still a lot of refinances out there, 154,000 a month. So there are plenty of opportunities. All we have to do is get our mindset right, be tactical, strategic, and seize those opportunities. And we can do very well, both on the real estate and mortgage side. I want to focus on those. But one of the things that's important to both mortgage and real estate is interest rates. And a big factor on interest rate side is inflation. So let me just chat with you for a minute here about inflation, because there's so much talk about it. Inflation's gone up. Now, the rate of inflation's come down, but that's only additional increases, right? It's not like inflation is itself is coming down, where prices are coming down. Prices are rising at a slower pace. So there's still a lot of pain out there. There's a lot of people that are struggling and hope, having to pay a lot more because of the inflationary pressures out there. But the rate of change is what the Fed's interested in. And what the Fed's told us is they said they want inflation to be at just 2% per year. And they measure that by something called the Personal Consumption Expenditure Report, or PCE. And they strip out things like food and energy, which could be influenced by, oil crisis or droughts. So they remove those two. And what they call the core rate of inflation on PCE, personal consumption expenditure, they want to be confident that it's going to be close to 2%. And then at that point in time, they said, well, that will be a cue for us to start cutting rates. So it's important for us to understand inflation and then see where the Fed's going, because listen, every single one of you, now, you don't have to be an economist, but in this environment with so much going on, with all the technology, all the AI, all the access to news, we have to be better than just a salesperson. We have to really be an advisor. We have to be a guide for our customers. So when your customer says, hey, is this a good time to buy? Our rates are going to come down. What's going to trigger that? We can't just go based upon and say, well, boy, if I knew that, I'd be having a pina colada on a beach somewhere. We really have to be able to at least frame the question so that real estate agent, if you're a real estate agent, you can talk to your customer. If you're a mortgage professional, you can talk to your customer and gain their confidence and gain the fact that they will also trust you more. Don't you just trust people more when You feel that they've put in the time, the effort, the energy to be educated, to be experts, to be masters of their craft. And we all know trust is everything in a transaction. Okay, so back to the slides. I want to show you a chart of inflation because it's come down a lot. And we've made progress in the rate of change. Remember, the increases have come down a lot. They were going up at 9% a year. In fact, I remember talking with you folks, made a pretty bold prediction. We said, hey, last year, around this time, we thought that inflation would come to 3%. It was at 9% when I first talked to you earlier in the year. We said, well, come the May report, we see inflation at 3%. Everybody thought we were kind of nuts. And guess what? It came down to exactly 3%. The problem was what we also thought was, hey, as a result of that, mortgage rates have always come down. And we think they're going to come down too. That didn't happen. There was other reasons for that because a lot of debt was being added. And I bring that up because just today, out of Washington, the spending has gone bonkers. They thought our deficit would be $1.6 trillion. Well, just today, the Congressional Budget Office says, oops, there's some additional spending. Instead of $1.6 trillion, the deficit's $2 trillion. These are incredibly large numbers, folks. And, I don't want to get political or anything, but, we are seeing a lot of government spending, whatever the political basis is, that's not important. What's important is that this additional spending has to be financed by selling treasuries. And the additional supply of treasuries usually makes interest rates a little more stubborn to the upside. We saw that in 2023. Now in 2024, there's other things happening that we're going to talk about in a minute that can help the Fed start to cut and start to see interest rates come down. But no, we're battling it on two fronts. We've got things working for us, but meanwhile, we're spending money at a level that's causing a lot more paper to be absorbed. The absorption of that paper means that interest rates get a little bit more to the upside due to the fact you got to give people an incentive to buy all this paper. Okay, let's go back to the charts. So here we go. Let's take a quick look at inflation. As you can see, we saw inflation zoom up, right? Lots of reasons for that. There was spending, the Fed kept rates at zero, all the quantitative easing from the Fed, but we have made a lot of progress. And wouldn't you know it, right? When we got that May report, we were down to 3% inflation. That's a pretty good thing here, but we wanted to get towards 2%. Now notice how it's been stubborn. This chart shows you the overall rate of inflation, but you'll see there's 3 shaded areas: the gray shaded area, the blue shaded area, and the orange shaded area. Well, this orange shaded area is shelter. Shelter is your rents and something called owner's equivalent rent. And notice how that's kind of moved up. It's coming down slowly, but this takes a while. The Bureau of Labor Statistics is very, very lax. They're still showing that shelter is going up at 5.3% a year. When we look at everything else, things like Truflation, ICE, CoreLogic, apartment list, they're more in the range of 3% a year. That's a very big difference, folks. And that's adding a lot to what the Fed's looking at for inflation, what the market's looking at for inflation. That really is, it's just lagging. It's just old data. It's like driving and looking in the rearview mirror. As you can see, it's coming down slowly and it'll get there. But now notice this blue section here. You know what that is? That's motor vehicle insurance. And I don't know what the Fed could do for motor vehicle insurance. You could hike all you want. You're not going to change, things like theft, but you also have all the technology today in a car. Think about your bumper. You've got your lane departure, you've got your parking assist, some got automated parking, you have your GPSs. There's so much technology that just a little ding can be thousands of dollars. And car insurance has been costing more. In fact, car insurance accounts it's like 0.8% of the inflation readings we're having now. Now, we're starting to see a little bit of reprieve with the last month's car insurance numbers because automobile prices are not going up. In fact, they actually are starting to come down. So will this come down? Let's take a deeper look. I'm going to take you behind the scenes and show you. Now, when they say, okay, what is the current rate of the PCE? It's 2.8%. The Fed wants it to be 2. Now I'll take it out to decimals. They round it to 2.8, but it's really, everybody will say 2.8, but it's really 2.754. So let's take a look at how can we forecast this going forward, because will we get to 2% and when, so we know when the Fed's going to cut. So the way we calculate this is we say, okay, 2.8% or 2.754 That's made up of the last 12 individual months inflation readings, and you add them all up. So we're going to get the next inflation reading on the 28th of this month. That will be for May of 2024. So when we get that, what you get rid of is May of 2023 because it's the most recent 12 months. What was May of 2023? It was 0.288. So that tells us for 11 months, it's 2.466. Now, we need a full year, so we got to add May of 2024. We're going to get that the 28th. Now, we don't know what the number is going to be, but we've got good forecasts. There's other good forecasts. We think, and we could be wrong, but we think it comes in at 0.1%. A 0.1% plus the 11 months here will give us a 12-month reading of 2.566. Now, this could break either way. You could see with the decimal, could it be 2.6? Could it be 2.5? But either way, we'll be reducing from what the media shows now as 2.8% to either 2.6 or 2.5%. And I think the market will like that. So I think June 28th should be a good day for interest rates. Now, remember, there's other things that are happening, just like today. We got good bond-friendly news, right? We're seeing the jobless claims, people filing for unemployment, showing weakness in the job market. But the bond market didn't really respond well because we got the surprise announcement. So there's other factors that could always come into play. But to me, it looks like towards the end of this month, we should see some improvement in mortgage rates based on this. So let's take this same philosophy and let's go out for the rest of the year and say, okay, the Fed wants to see it confidently towards 2%. Will we get there? And you know what was interesting, team? What I'm going to show you now, so few people know. In fact, all the people and the faces you see on CNBC or on TV in the media, they're clueless to this, even people at the Fed. Now, if you watch the last Fed press conference, and if you didn't, you could always pick it up online, you'll see Steve Leisman. He is the chief economist on CNBC. This man is, of course, he's a very smart man. Nothing to do with his individual intelligence, but he just doesn't understand stuff like this. And Jerome Powell took him to school because here's what happened. And it was embarrassing for him. So what you're about to learn is more than just about anybody in the media and even many people at the Fed. He was asked, well, he said, look at the Fed's expectation for inflation. They think by the end of the year that inflation will actually rise. And he was like shocked. And he asked Jerome Powell, says, why? And Jerome Powell said, it's not because inflation's rising. It's because the outgoing ones, remember how we had to do this, the May of 2023, the outgoing ones? He says, those were very low in 2023. And that's what caused it. And I'll show you how. So one more time, let's do it. Here's our forecast for May of 2024. We're going to get that June 28th. The outgoing is 0.288. So if you take the rate of inflation, add the new number, subtract the outgoing number, it should be 2.566. The Fed's going to see that number before the July 31st Fed meeting, but they're also going to see the June number at the end of July. Now, we don't know what these numbers are going to be, but a reasonable guess might be 0.2% per month. As we get closer, we'll get better estimates. It could be a little higher, it could be a little lower, but let's just put these in. When you look at the outgoing number, we're not going to make much progress before the July 31st Fed meeting. And then look at this. The inflation actually goes up to about 2.8%. And this is what the Fed's target was. And this is why Steve Leisman was so confused. It's not that inflation's going up at a big amount. Inflation's pretty tame. But look at what the readings were in 2023. They were so low that even when you take a low number like this, when you replace an even lower number, the rate of inflation goes up. So does that mean that the Fed will not cut based upon inflation? Well, if the Fed had one mandate just upon inflation, maybe that might be the case. But the Fed has another mandate, and that is maximum employment. And that's what we have to look at, the employment mandate. So let's take a look at what's going on in the job market right now. See, Jerome Powell said a few things a little over a week ago. He said, well, the Fed's policy is restrictive. That's code for rates are too high. It will slow down the economy. We risk a recession. So any chance we get, we want to cut. He also acknowledged that the unemployment rate crept up 0.6% from the low. What does that mean? The low in this cycle was 3.4%. It is now 4%. When you have, in our history, in our nation's entire history, whenever the unemployment rate from the cycle low has gone up more than 0.5%, there's a recession. So he's aware of that, but he also tempered it. He said, but 4% is still historically low, and that's where we are right now. He mentioned the quit rate. Why is the quit rate important? The rate of people quitting their jobs is less and less and less. So why would you quit your job? You're getting offers elsewhere. You're being poached elsewhere. The job market's so hot that people are trying to draw you out. But he's seeing that drop, which what does that tell you? It's not as robust. And he sees job openings are lower. Then he said, but the amount of job openings are 8 million. There's like 5.5 million unemployed. So it's still kind of more than the people unemployed, meaning there's more job openings than those unemployed. But here's where he doesn't get it. And I'll tell you why. This is something that Jerome Powell should understand. You see, this comes from a report called the JOLTS, JOLTS, stands for Job Openings and Labor Turnover Survey, JOLTS. That study, it's conducted by each individual state. Now, it's okay if each state tells you how many job openings there are, but think about what's changed since COVID. We have work from anywhere. It's very, very prevalent. So if you were looking for a job, for a work from anywhere person, you might not just put it in one state. You may put that job opening in 2 states, 5 states, 20 states, which means that same job opening will be overstated 2, 5, 10, 20 times. We don't know how many, but certainly the job openings are very overstated, and I don't think Jerome Powell's considering that. Now, he also said he sees wage increases are slowing down. And he also acknowledged something very important. He said that there's a big discrepancy, and I'll get into this, in that jobs report between what's called the business survey and the household survey. There's 2 different surveys that tell you how many jobs. The unemployment rate comes from the household survey, where they actually call people and talk to them. The business study, they do some surveys for big businesses and small businesses. They use some models called the birth-death ratio. He even said that the business survey may be overstated. And it is, folks. It's so freaking overstated. It is, it's not even within the realm of reality. Let me show you how. Last month, we said 272,000 jobs were created, much higher than estimates. That looks like it was a blowout report. Wow, the job market's so great, right? But 231,000 came from this thing called the birth-death model. The birth-death model says, hey, look, we can't tell how many small businesses jobs were created because, who knows, in the deli or in whatever it was, the clothing store, how many jobs were created. It's very hard for them. So they say how many of those businesses were born and how many died, birth, death. And then they guess how many employees might have been working there. So this is a very unusual way to do it. And think about this. If you've ever had a small business doesn't just close its doors and just go under. Even if the small business closes its literal front door, the business stays alive because they got to do tax filings and things like that. So they don't end the business for month, year afterwards. That means that the BLS is still showing that as an active small business when there's truly no activity. So let's look at the ADP. Now, ADP looks at real payroll records. They look at 10 million payroll records. They didn't show 231,000 gains in the birth-death model. They showed 10,000 losses, and that's much more accurate. So you think about this discrepancy here, we'd be in a whole different position. Now, the household survey, that didn't show 272,000 gains. You know what they showed? 408,000 losses in the job market, okay? And the unemployment rate moved up. So that is a huge discrepancy. Think about it, from 272,000 plus to 408,000 minus. This was what Jerome Powell is looking at. The Bureau of Labor Statistics is just not reliable. And we're taking full-time jobs and losing them and replacing them with part-time jobs. Does this sound like a strong jobs report to you? Now, there's something else that you should see here. That the Fed tells us where they see the unemployment rate this year. So there's 19 Fed members. 2 of them said they actually think the unemployment rate is going to go down 3.8 to 3.9%. I don't agree with them. 14 Fed members said 4 to 4.1. Well, we're already at 4. But here's where the golden ticket is, everybody. And this is if you were to talk to your customers. When will the Fed be forced to start cutting rates? To me, it seems like if you see an unemployment rate of 4.2%, well, that means 16 of the 19 Fed members are going to say, oops, we didn't see that one coming. Maybe the economy is in worse shape. Maybe the job market's in worse shape. Maybe it's time to start cutting rates. So even if inflation doesn't get there, Watch the unemployment rate hitting 4.2%. Now, the Congressional Budget Office says they see 4.4%. Now, there is help on the way starting this month. The Fed's actually started buying. They've started easing off on selling of their treasuries or rolling off of their treasuries. So they're going to buy $35 billion a month. And the Treasury itself, for the first time in 20 years, is buying $9 billion a month. So this is going to sop up about 13% of the supply. Now, remember, it's a push-pull here. We just got the surprise today that we're going to have to push more out there. So yeah, we're buying more, but they're selling more. So, let's hope that this kind of helps us a little bit here. And if you take a look, it's almost a push because $35 billion a month, that's $420 billion a year. And then you got another roughly $9 billion a month from the Treasury. That's another. So you got about $500 billion they'll be buying, but they got to sell another $400 billion. So, a little bit of progress, we'll take it, but it sure would have been nice not to get that surprise this morning. All right. All this talk about the economy, here's, an issue that many couples are talking about, and it's on their minds right now. And of course, we're talking about recession. I don't know what you guys were thinking about, but we're talking about a recession. And there's a lot of reason to believe that there still will be a recession. I know a lot of people say, no, it's not going to be a recession, ridiculous, this and that. You people, please don't rule it out. It can happen. Look what's going on. The only reason we haven't had a recession is because the consumer has been keeping it alive. But have you seen the last couple of months of retail sales reports? The consumer is getting tired. And how about government spending? We talked about that it's out of control. We're spending 23% of GDP right now. When was the last time we did 23% of GDP? The great financial crisis, the Gulf War, the double dip recession. We are spending today as if it's a crisis or it's an emergency. And that's what's kind of keeping things afloat. But as this spending slows down, we're going to see the economy, in my opinion, be pushed to a level that will feel like a recession or be an actual recession. And if you look at the consumer, as I mentioned, retail sales are very slow now. How about car loans? Car loans, look at the skyrocketing delinquencies. These are 90-day delinquencies. They're serious delinquencies. Look at credit card delinquencies, skyrocketing right now. And this buy now, pay later? Would it surprise you? This shocked me when I heard it. Do you know that 43% of buy now, pay laters are delinquent? 43%! Holy cow! That's not exactly a strong, robust consumer. And when you start using buy now, pay later for your groceries, maybe the consumer is a little bit stretched, folks. So I just made the case that rates are going to come down. And if you reiterated a lot of that to your customer, they might say to you, and perhaps it makes a lot of sense for them to say, well, okay, if rates are going to come down, maybe I should wait, right? Not so much, but you have to explain it. Now, you could use a cute saying, and you could say, well, you should buy the home today and marry the home, and then you can exchange the rate later and date the rate, which sounds cute and it's fun, but we've got to put some teeth behind it. And this is what I love about what Atlantic Bay does, is because they just put this in a way that is so usable for you. So let's go through a real example together. So the script that I would use, and you might want to write this down, is to say, when a customer talks about that waiting, you might say, look, I know it might sound funny, but that 7% rate, that's your best friend. That's the best thing that could have happened to you. What do you mean that's the best thing that could have happened to me? Because for every 1% drop in rates, and there's a lot of reasons that we just talked about that we're going to see a 1% drop in rates, at least 5 million more people become eligible buyers. Of course, they're not all going to buy, but a lot of them will. Inventory is already tight. What do you think when you got a lot more buyers out there? What's going to happen to selection, inventory, and then what's going to happen to prices? We just got the home builders report today, and we got housing starts today, that permits, they're down. There's not a lot of new inventory that's going to be out there. That inventory comes from builders building homes. It doesn't come from people that are existing homes selling. That's activity, but it's not new inventory, because remember, those people got to live somewhere too. So a seller becomes someone who becomes a buyer or needs a place that they have to occupy. All this will create upside pricing pressure, folks, for years to come. So the time to get in is now. So let's take a look at an actual opportunity. Let's say $700,000 home, 20% down, 7% rate. Here's your payment. Let's call it $4,600. Now, you might say, look, if I wait a year, now prices might go up. So let's take in your market, about 4.5% appreciation is the forecast. Let's take that. Okay, 4.5, 5%, reasonable. An 80 LTV, still 20% down, means you got to borrow more, but because the rate drops so much, your payment drops a lot too. So if I buy today, it costs me more money today. How much does it cost? It cost me $185 a month to buy today. If I waited, I'd save that 185. So that means during the course of the year, $185 times 12, I'm spending $2,220 to do what you're saying. You're saying date the rate, but dating the rate cost me $2,220. And wait a minute, what about the cost to refinance? Let's just throw a number in there. It could be less, but let's just say $4,000. So the cost to date this rate is $6,220. Heck, man, that's an expensive date, right? But what about the benefit of marrying the home? At just 4.57% appreciation. And please, this is why you have to do it, because your customers won't. That's $32,000. Wow. So if you take the benefit minus the cost, the real benefit of buying now is $25,800, team. This is why you marry the home and date the rate. It's not just a saying. There's reason behind it. And this is what I think you folks can do with the team at Atlantic Bay. They have a beautiful piece that they can co-brand with you and help you with this. This is something you need to show every one of your customers who are waiting. Waiting is expensive. It will cost you money. You can't just say it, you got to show it. Now, a lot of your customers are waiting as well because they say, I've got a low rate, right? And I want to wait for rates to come down because I'm sitting with a rate around 3%. Now, your mortgage might be 3%, but is that your overall rate? Now, if they have no debt, yes, that's true. But we know the vast majority of people have debt. So Atlantic Bay has this really great tool. It's called a blended rate calculator. It says, okay, I know your rate's 3.25 on your mortgage, but do you have any other debt? Yeah, sure, Barry, I got a car loan. Well, when we put the car loan in, you're really at 4%. What about store credit cards or major credit cards? Yep, I got some of those and I got some of those. Well, did you know your real rate's like 6.5%? That's pretty close to the market rate right now. So maybe one of the things we could do is when you sell your home, instead of taking all the money like most people do and putting it down on the new home, there's no tax differential for it, by the way, that's fact. You should think about maybe eradicating your debts, and then it makes the difference much smaller. Atlantic Bay has an amazing tool that they can walk your customer through that can help them consolidate their debts, buy that new home. We're seeing it happen every day where it's pretty close to the same payment they're making today, or even if it's a little bit more. People pay a little bit more because they had a child, they want the backyard, they want the home office, they want the garage, whatever it is, they want to do it. You just have to allow them to do it by showing them it's not a big change in monthly payment. Give them permission to do it. This tool will help you. Atlantic Bay will help you. Here's another issue you might be coming up against. And that is that with tight inventory, there are homes that when it's priced right, it's hot, it goes right away. And a lot of times it's going to go over asking price. Now, look, those of you that are on this call that are real estate agents, look, listen, God bless you folks, because it's not easy. What you do is hard to bring people around. You're showing them homes, and not a lot of inventory means that a lot of homes won't check off all the boxes for them. And that creates an issue. It creates a problem due to the fact that someone may be wanting to buy that home, but it's just not right for them, so it's a pass. So now when they find a home that checks off all the boxes and it's priced right, boom, they jump all over it. So they find a home for $630 and they put in a full price offer. What happens? Well, I don't have to tell you. Somebody comes in at $640. Now, they can probably win the home if they bid $645, but that's $15,000 over asking price. And the problem is maybe they can do it financially because, these amazing people at Atlantic Bay, they've got so many products, programs, they can make it work. They can get them to qualify in many cases. Of course not, but in many cases, maybe it's a smaller down payment. Maybe it requires MI. They are so creative. They will help you get that customer financially into the home. But what about psychologically and emotionally to get them to pull the trigger and say, well, am I willing to pay $645 for something that's worth $630? And the beautiful thing about what you could do right now is you could show them the answer to two questions that they need to have answered. Now, the thing of it is you have to educate them because they might not even know. Here's the two questions. Number one, how long will it take you to break even? In other words, how long is this home that's worth $630 going to take to reach $645? Well, we have that data. So this is question one. In this market, we can look up in this zip code, what's the forecasted appreciation with a high degree of accuracy for the next 12 months? And right now, I'm picking something modest, 4%. Hard for people to figure this out, but that's only going to take 4.9 months. And by the way, that's from today. It might take 2 months for them to close. So, hey, Mr. and Mrs. Client, you realize 3 months after you close, you broke even? That might change their perspective. They might say, well, 3 months, that's nothing. Wow, I can get this home of my dreams and be at a break even in 3 months. That's not bad. But now question number 2, what happens in the future? Let's say 5 years from now, is this a good investment? Well, we have that data. So the average annual rate of appreciation is forecasted in this market to be 4.28%. And just to give you a point of reference, in this zip code, for the last 63 years, it's been 4.5%. So very close. Now, as smart as we all are, and we're all pretty smart, it's kind of hard for me and you to take a $630,000 value, times it by 4.28%, and compound that per year for 5 years in our head. It's just not easy to do, which is why we have to do the math. And it might surprise you that the value of this home, 630 today at 4.28% compounded for 5 years, would be $783,000 5 years from now. Now, if I'm paying 645, if that's my cost, 783 minus 645 means I made a profit in just 5 years of $138,000. And you might say, hey, it's a pretty good deal to get the home of my dreams, even though I'm paying $15,000 over asking price. This is the solutions that I love that Atlantic Bay brings to you. And they can even take the customer down this journey and walk them through. Team, listen, I am just have to excuse myself for 2 minutes. This is all part of the chemo. You got to just give me 2 minutes. I'll be right back. Okay. So put on your dancing shoes, Bill and Emily. I will be right back. Okay.
We are totally fine with that. So there's been some good chat that has been coming in around questions around MBS Highway, and it is a great tool that our mortgage bankers here at Atlantic Bay have access to. And one of the questions was on one of the tools that Barry had talked about, and one is cost of waiting, and it really goes through that whole example. It shows a client that sure, you can wait until tomorrow, next month, next year, but here's what that cost looks like. And that's the example where he was showing, here's what the cost is today. And then yes, if the rate goes down, your payment may be a little bit lower, but again, you're losing that equity position that you could have built during that time. The other one is the blended rate calculator, which I think is fantastic because, he went over that pretty quickly, but you do have customers that have installment debt, they have equity lines, they have all the different debt that is attached to the home. So when we talk about affordability as being a lender, it's not just the rate, it's not just the payment, but it's the whole package. When you sit down and you're actually writing your, I guess people don't write checks out anymore, but if you're writing your checks out or doing your online banking, how does that feel after you're done doing all those subtractions? Do you still feel good about it and feel like you could, go out for that nice steak dinner or take a vacation? Or do you feel like, oh my gosh, wait a second, all this adds up? And that's what that shows very well. And it shows in a great graph, great presentation for the agent to now take to their client or for the mortgage banker to present to the customer as well. So Barry, hopefully I did a good job kind of touching on
amazing.
Those
You're
tools.
amazing.
You taught me well.
Oh, you're amazing, brother. Thank you. Okay. Apologize. We're back. Okay. So now there's been so much talk about renting is better. I see it like almost every day. The New York Times has been on a rampage because they put out this new calculator, and it's like almost giving people permission to say it's the cool thing to do, rent and not buy. And I think that's one of the worst bits of advice that we can give. So let me show you the New York Times article that just came out. And it says that renting forever and trying to create a strong financial future, either by choice or they're priced out of the market, many people plan to never stop renting. Building wealth without home equity requires a different mindset. So they're like telling people to do it. Renting can be a better financial decision. Over the last century, the S&P 500 has returned an average of 7% a year when adjusted for inflation. So they're saying to you, don't put the down payment. Renting is monthly payment wise, initially cheaper. Take that money and invest it in the stock market. By the way, who's going to do that? Okay, but let's just say they do. And then they have the audacity to say, remember, there's millions of people in America who rent and invest the difference. Really? Okay, let's just say they do. So here's what we're going to do. We're going to give you an example. And we're going to try and even take their example and make it even worse for buying a home. But here we go. $500,000 home, 10% down is a $450,000 mortgage, 7%. The monthly payment on a mortgage, $4,378. If they rent, it's $727 a month cheaper. But they never tell you that that rent continues to go up. And the average rent in the United States on a renewal is going up at 5%. On new rents, they're actually coming down. The blended amount is about 3% a year. But remember, if your property is vacant and it's a new rent, you got nothing coming in, so you're going to give an incentive. If it's a renewal rent and you're the landlord, you know you got a little pricing pressure because you know it's a pain in the butt to move. It's a pain in the butt and it's expensive. So you can push it 4 or 5%. And in this zip code, rents have been going up at 5% on renewals. So that's what we're going to go by. And this person, like the average person, they're going to be in the home for 9 years. So let's go a step further. Hey, buying a home is also got a couple of other things you got to consider. Your real estate taxes could go up. You've got expenses for repairs that if you were renting, you would have the landlord pay. And if you were renting, you don't have to worry about a cost to sell, but let's factor that in on a buy. So let's consider all of these things as well. But what about appreciation? And appreciation in this particular zip code, I tried to go real conservative on everything, everyone. So while around the country, it's closer to 5%, here it's only 4.13%. And in this particular zip code for the last 63 years, it's been 4.2. So you can see pretty much in line. So just 4.1% appreciation. Okay. Now, remember, they talk about how it's much better in the stock market. Stock market, you're going to get 7%, right? So much better than 4. Okay. Let's take it step by step. We know buying is more expensive than renting by $727. So they're saying you're going to invest this difference. Okay. Let's take a look at each year, though. And these two bars here on year one, the left bar here, that's buying. Here is renting. So buying is, as you can see, it's a bigger bar, $727 more expensive. But notice what starts to happen. By the time year 5 comes along, it flips and renting becomes more expensive. But you see these different colors in the bar. Please pay attention to the black one. The black portion that I have on top, that is principal. Now, principal is not a cost. That's your building equity. That's your own money. It's literally a forced savings account. So it really isn't a cost. When you factor the black bar, by year 3, you break even, and by year 4, renting is more expensive. So a very short time frame that you would have a little bit of a benefit on the rental side from a cash flow perspective. And if you just said straight cash flow over the 9 years, you're renting, you've spent $483,000, you're buying $480. It's actually a little bit cheaper to buy than it is to rent. Not too bad. Okay. Now, the big thing is the principal. Remember I showed you that black bar? After the end of 1 year, you got $4,500, 2 years, $9,500. By the time year 9 rolls along, you've got $55,000. Why is that? Because what you started off with was a $500,000 home and you put $50,000 into it. Well, now that $50,000 has gained another $55,000 in equity because the mortgage amount that you owe is not $450, it's $395, let's call it. So now you have an extra $55,000. And what about the big one? Remember that 4.1%? We'll compound that out. That's why Albert Einstein said it's the 8th wonder of the world, compound interest. 4.1% on a $500,000 home for 9 years. Would it shock you that home's going to be worth $720,000? It means you're going to make $220,000 plus the 55. And then what about your tax benefit? Now you do get a tax benefit for renting, so you got to be careful here. So what's the tax benefit over and above renting? It's another $21,000. But then you have a cost. So let's figure 6% cost on the future value of the home. So how much is it better to buy than rent? Well, it's $245,000 better buying than renting. And you can see it changes each year. Okay, right? Year 1, if you're going to be in this home for a year, well, rent, because the cost to buy and the cost to sell, it doesn't make sense. But if you're going to be in this home 2 years or more, why in the world are you not buying this home? And I think this is a very important argument to give. And what's beautiful is that Atlantic Bay can do this, co-brand this with you and show this to you. But wait a minute. Remember the Times said millions of people are investing it? Okay, right. Let's just say somebody has the discipline to invest. So in year one, they invest $727. And let's assume that the stock market doesn't come backwards and keeps giving them 7% return. Well, that means after 1 year, they would have accumulated $8,700. They gained 7%, which means after year one, that $8,700, this is $727 a month times 12, would be $9,300. And then another 7%, another 7%, and so on. At the end of the 9 years, that $727 a month that they saved in year one amounts to $16,000. Now, in year two, because the rent went up, they saved less. In year three, they saved less than that. But if we do the exercise, right, well, now you can see they're saving some money. But something starts to happen as that rent gets more expensive. You actually start losing money. So at the end of the 9 years, you're still ahead, and you gain $7,000 grand total when you do the math. So New York Times, welcome to a spreadsheet. This is what you should be doing. But wait a second, the big one is, what about the down payment? See, if I buy the home, I've got the down payment's $50,000. Let's throw another $10,000 for closing costs. What if I were to invest that $60,000? Yes, let's figure that in. But wait a minute, if you're renting, you probably got to put at least a month's worth of security away too. So let's do the right math, right? So you got $50,000 down payment, $10,000 for closing costs minus the security. That would give you, if you rented, an extra $56,400. Now let's invest that at 7%. And the number comes out to, you would gain $48,000, because you could see it starts at 56. You gain money the first year, second year, third year. So you're going to wind up with $103,000 minus your $56,000, gives you a profit of $48,000. Add that to the $7,000 from the cash flow, is $56,000 benefit after 9 years. But remember our previous example? Remember $245,000? You're still better off by $189,000, even if you had the discipline, and even if you got 7% in the stock market, you're still better off by $189,000. And by the way, here's the one thing the New York Times never talks about. During this 9 years, what if rates come down? You see, if your mortgage rates come down, what are you going to do? Well, you're going to refinance, which changes this whole equation, because now you might be cheaper than what it is renting faster. These are things that the New York Times won't tell you, because either they don't understand it or they've got a different agenda, and they're not alone. It's so many people that don't understand this concept. That's why you, as the professional real estate agent, mortgage professional, have to be able to break this down. And Atlantic Bay has tools for you to do this. Now, net worth. We all want to gain net worth. If you want to be in the top 1% in the United States, well, your net worth needs to be 11.6 million. It's a big number. How about just the top 2%? So if you go down from 1% to 2%, notice the big drop here, by the way, 2.7 million. Still a big number. Top 5%, 1.2 million. Top 10%, 900,000. And if you want to be in the top half, 600,000. I thought this was a very interesting study, but the best part about the study is, where did this net worth come from? And what it showed is that in the United States, 2/3 of all net worth, it came from home equity. It's very hard to get rich being a renter, folks. I'm not saying you can't do it. It's just really hard. And did you know, on average, the net worth of a homeowner versus a renter? 40 times. That's not a typo. 40 times. So please, let's help people see the benefit of home ownership and use the tools that Atlantic Bay has. Now, when it comes to housing, people are worried about the housing bubble. Okay, can it happen again? There's a lot of big differences. In 2007, there were 4 million units in inventory. Today, there's 1.2 million. So you got roughly 3 million less units, but you also have to look at population. In 2007, we had 301 million people in our population. Today, it's 340 million. So you have 39 million more people fighting for 3 million fewer units. Very hard to have a bubble. But let's go further. This is a beautiful chart. And what it shows you is two things: blue lines and gold bars. These blue bars and gold bars are for the past 20 years. And what they represent here is how many blue bars households were being formed, gold bars, how many completions from builders. So these are builders completing homes. And this is where inventory comes from. So as you could see here, they were putting up like 2 million homes a year. Since then, we haven't even done 1.5 million. And if you look at today's permits, it looks like we're doing 1.3, 1.4 million. So much, much less. But the blue bars, those represent household formations. What's that? Imagine mom, dad, and a child in a household. At some point in time, that child grows up and gets their own place and they leave the household. But it's still the same family. It's still mom, dad, and a child. However, instead of one household, they have two. So what they have done is they have formed a household. This measures how many formations there were. And notice in 2004, 2005 was pretty close. But what happened in 2006 started the housing bubble. Builders went crazy. Household formations drop off a cliff. Similar story in 07 and 08. And there was just too many units, not enough buyers, and the housing market crashed. If you want to see why the housing market is so strong, look at here. Too many buyers and not enough units. So the questions to help your customers are, as their advisor, you want to protect them. Hey, can this bad thing that happened in 2006, 7, and 8, 9, and 10, can it happen again? Let's examine it. Well, we know good visibility into the completions because you don't blink and a home gets built. When you look at the time it takes to build a home and approvals that you have to get and permits, we know for the next couple of years what's going on. And for the next couple of years, this is only in the range of 1.3, 1.4 million. So this isn't going to explode to 2 million like it did here. We know that. Could we see a big drop in household formations? Well, here's where it gets interesting. Now, I love saying this, that demographics is destiny. It's one of my favorite things to try and predict the future because it is. You see, we did very well here and we were one of the only ones that called the housing bubble. In fact, out of business, I sold my business in 2006 and 2007 because I saw this coming. It just didn't make sense to me while everybody was gung-ho on the market. Why? We looked at these household formations and we saw that they were going to drop because we said, what's the median age of a first-time home buyer in 2006? It was 33 years old. We said, okay, so that means when were they born? So 2006 minus 33 years, they were born in 1973. Were there any events in 1973 that caused births to drop? And sure enough, there were. Let me show you the birth chart from 1973. Wow. What happened? Abortions were legalized. Because abortions were legalized, birth rates plummeted, and 33 years later, a lot fewer people purchased homes. What about today? The median age of a first-timer's changed. It's not 33, it's 36. So that means they were born between 1987 and 1988. Let's look at the birth rates there and look at what's going to happen. Here's your birth rates from there. So it's a lot more than it was here with a lot fewer homes. Look at this. The next few years, you're going to get a big uprise. So we think these household formations will increase. Our forecast for this year is 5% appreciation and transactions going up. That's across the country. Each neighborhood area is different. Atlantic Bay has it for your individual zip code. There's a lot of wealth to be created through real estate. Look, I just said 5% appreciation. Is that exciting? Well, take a $500,000 purchase, 10% down is a $50,000 investment. 5% appreciation is on the $500,000 purchase. That's $25,000 profit. $25,000 profit on a $50,000 investment is a 50% rate of return. This is how you create wealth. This is why those net worth numbers are so high. This is the magic behind it, folks. Now, a lot of you are curious about commercial real estate. You're hearing a lot of negativity. I'm worried about commercial office space. The best data that I get is from a group called Castle. This is their back to work index. So if you were to say pre-COVID, now I know not everybody was working from the office, but if you were to just say the level of people represented 100, okay? We had the big COVID drop, but how many of those people have come back to work in the office? Whoa. We're 4 years later. Half. And look at this. It's not coming back, folks. Work from anywhere is here to stay. So what does that mean? I bring this up, not if, look, if you're interested in commercial, great, but there's a bigger picture here. We have to play chess, not checkers. The reason why we bring this up is because I want you to think of banks and the banking system. Now, when banks do loans for commercial, it's not like a mortgage where it's 30 years. Those roll over 2, 3, 4, 5 years from now. Okay, so rates were very low in 2020, 21. So a lot of those loans are going to start rolling over or have started to roll over, which means somebody who owns commercial real estate, they might have been paying 5%. Now they're going to be paying 10, 11, 12%. Okay, that's a big expense. But think about the other side. The leases that they signed back here are rolling over. Do you need the same amount of space? Do you need more space or do you need less space? So The banks gave loans to people who are going to spend a lot more every month and are taking in a lot less income every month. What does that mean? That some of those loans are going to have problems. Some of those banks are going to have problems, and that's going to fall on the Fed, and the Fed's going to have to start thinking about cutting rates. All this paints a picture for the future where we see rates coming down. And listen, for you real estate agents out there, we had Arnold Schwarzenegger, The Rise of the Machines, remember? Well, I want to talk to you for a minute from the heart here, because on August 17th, you got the rise of the listing agent. And this is very important. Now, statistically, I mean, this is anecdotal. You might know this, but only about 20% of agents are predominantly list, 80% are predominantly buy. And it makes sense because, look, anybody who's going to get into real estate, it's a normal path, not everyone, a normal path. Hey, I've got a friend, I've got a relative, I've got a neighbor, and I come in on the buy side. But listing's hard. And that's the great thing about Atlantic Bay, is that they're there to help the listing agent in today's environment. So some of you that are going to have to do more listings, because that's where it's at, Atlantic Bay is here to help you. See, here's their listing agent strategy. They can go on a listing appointment with you. They could give you a third-party endorsement. It shows strength, but they can explain how they can pre-qual buyers, and they could show you those tools I just showed you, the buy versus rent. They could show you that bid over ask. They could show you the strategy for where we are. Oh, goodness gracious, forgive me here, but all of the things that Atlantic Bay has in their arsenal that they can talk to your customers about: the cost of waiting, marrying the home and date the rate. Forgive me. Yes, all of those. And also remember, we talked about that lock-in effect for potential buyers. So they can help you explain to your potential listing client why they need to list with you, because you are partnering with a financial institution who will help that listing sell at top dollar with them and get more qualified buyers. And then what about if that listing gets a little cold feet, because they might want to sell their home and then they say, oops, look at what might happen here because rates are up and it's going to cost me so much more to buy a home. You don't want them to back out of that listing, do you? You can overcome the lock-in effect and show them that same strategy for that individual person at the listing. Now, what about a buyer's agent strategy? Here's the thing. And I got to give credit to my dear friend for many, many years, Tim Brahim. He's brilliant, by the way. And Tim and I have been working on stuff together, and he gets a lot of credit for this, but he coined this. He says, you have to create a fused presentation by meeting with the buyer's agent together. The buyer's agent and the mortgage professional at Atlantic Bay should meet together and create a presentation. And here's some questions. Those of you that are buyer's agents on here, here's questions you have to answer yourself, okay? Because your previous script was easy. Hey, you don't have to worry about me getting paid because the seller pays me, right? So here's a few things that I want you to think about, team. Let's get real together here because we're here to help each other, right? So let's not sweep this away. August 17th is around the corner. Questions that you're afraid of being asked by a buyer. Can you share that with your Atlantic Bay representative? What questions are you afraid of being asked by a buyer? It's okay. Because look, if you're a buyer's agent, this might be the very first time where you have to negotiate. See, listing agents, they have to negotiate with the person in front of them. But if you're a buyer's agent, this might be the very first time you're going to be asked to negotiate cost. And what is the cost to work with you if I'm a buyer? What is that? Because look, if it's a $1 million home, if it's 3%, that's $30,000. How do we justify that $30,000? What if the seller isn't willing to pay a buyer fee? How are you going to handle that? And the public's perception, it's not our perception, but the public's perception is, oh, you don't do very much, you just show them the home. We know it's much more. How are you enlightening them on all the things that you do? That's why this presentation is so important with Atlantic Bay, because what they get to do is third-party endorse you. By third-party endorsing you, they can explain to that buyer that you're the only one out there that's got their back. You're the only one that represents them, that's going to negotiate the deal, that's going to dissect and inspect the inspection for them, the important information on schools, the quarterback, insurance, mortgage, utility. You're the one who does that. So yes, you can do it, but your Atlantic Bay teammate can be giving them these critical things that they need to do. And they can bring things like an AVM, either on the listing or on the purchase. An AVM is great. Every property in the neighborhood and the subject property. help you market it to a better price. All the comps done for you, and a neighborhood report. Here's one of the best ones, a real estate report card on the opportunity. And they can quickly and easily bring all these things to you, either at the listing or buyer side presentation. That's what we need to be doing. Look, the seeds have been planted now. Now's not the time to withdraw. And look, on the mortgage side, team, there's 10 million loans that have been done, 10 million in the last 2 years that are going to be right for a refinance. Are you talking to your customers now? Look, take it from somebody who did loans for a long time. I did 2 billion in transactions. I've been through so many refinance booms, and I learned early on that what I've got to do is establish a strike price with all my past customers. If you're not establishing a strike price, you're missing the boat. What is a strike price? What is the rate where it makes sense to refinance? Not after rates come down. Now, because after rates come down, it's a free-for-all. It's crazy. Processing times get jacked up. And now the client has to think about it, and they may miss that window when rates drop in case they go back up. You got to do this today. So if you have the conversation with them today, establish a strike price, then what you're able to do is call them and say, hey, we got the rate we're looking for. Let's do it now before it goes back up. And boom, you're done. Real estate agents, same thing. At what rate is the strike price where you're ready to make that purchase? Establish a strike price. Atlantic Bay can help you do that. Mental preparation when facing adversity, like the ones you're facing right now. The things we're talking about is being mentally and tactically prepared. So you have to understand your obstacles and evaluate them, because you can't fix what you don't know. That's why we're trying to learn about our adversity. For me, I think you have to map out a battle plan to conquer these things. And folks, you want to seek expert advice. And that's why Atlantic Bay constantly does this. And as a team, you guys make a very formidable team that can get through this and win and take advantage of the good times that are just around the corner. Just copy the winners, copy the strategies that we're seeing that works. Now, sometimes it's hard to copy the winners because there's very little out there. For me, that was the case. I just want to talk to you personally for a minute here. You know, when I found out about my type of cancer, which was very scary, you know, you talk to the doctors, and I wanted to know, what could I expect? What will I be working? What are the side effects like? What's and you know, they don't really give you a lot. And there isn't a lot of people you could talk to. So here I am. I was going to start my first round of chemo April 8th for the 5 days, Monday through Friday for round one. And it was the Saturday night before that. And I'm not ashamed to tell you, I'm terrified. I mean, I'm still scared, but terrified. And I didn't know what to expect, because I wanted to be active. I wanted to be able to work. I wanted to know what it was going to be like. My son, Jared, his girlfriend, Hannah, is there. And Hannah works at an animal hospital. She says, you know what, there's a vet there, Dr. Ben, and he just finished 6 rounds of chemo. And while every cancer is different, he said, maybe he can give you a little bit of insight as to what to look for. And I wound up having a discussion with Dr. Ben, and I got off the phone with him, and it just gave me the confidence and the courage to say, okay, you know, at least I know what to expect. And I was like, why is this not available? And so, you know, my preparation and plan for it was that, you know, you can either feel bad for yourself, which is easy to do, or that's why it's so important. I started with gratitude. Just draw up on the gratitude and do something positive. So what I decided to do, folks, is I decided to do something positive. And I said, I want to help other people. Maybe God's put me in this position so I could do something. And so what I've been doing is every single day, I take a very short 1 or 2 minute video of what I'm experiencing every day. And I include on it little tips as to how to alleviate this, or what to expect, or you know, what you can do to be more productive every single day. And I'm putting a library together. And what I want to do is I want to make this available so that if people are heading into this, or their families heading into this, that they have something that they can draw upon. And I hope it gives them the courage and the strength to go through it. My dear friend, Tony Robbins, who, you know, we talk to almost every day, he wants to make this available. So we want to do something good. And what I did is I just put together just a minute and a half. I want to give you a sample of what it looks like. Okay. So bear with me a second. I'm going to share, and I'm going to share with sound, and I'm going to bring this to you right here. So here's day one. Was it April 8th? I look a lot different, don't I? You know, 2 months later, stuff wipes you out here. But let me just show you day by day. You know, and by the way, I talked about when you can expect to lose your hair. What does that feel like? What are the things you could do? You know, so
this is day 1 of 5 days of treatment of round 1 of 6 treatments separated by 3 weeks. Had the big bag and was a little tough to sleep with last night, so that's with me till Friday. But be able to be free and walk around. Yes, the bag's an inconvenience, but it's a blessing that I can be kind of normal. The things that we take for granted in life, you know, just moving around, being able to take a shower without having to go through gymnastics, being able to sleep, and just the mobility. Boy, we sure are blessed. Makes you really think. I didn't sleep well last night because the Cytoxin that they give you, you have to drink a ton of fluids, a lot of water to flush it out because it could cause issues with your bladder. It can give you the gout. So I was so panicked about that. I drank a shit ton of water and I was literally up all night peeing. So, and tough to go to the bathroom too. So, you know, these are some of the side effects that you get. But other than that, okay. I feel okay. My energy's okay. I actually got a workout in today, was out all day today. So, you know, I'm in good spirits. I'm happy. And I'm very grateful. I'm grateful for everything, you know, grateful for Rosa, my family. I'm grateful for my friends, the love that I've been just so surrounded with. It's great. I'm just grateful for everything that you notice, you know, it makes you think, you know, like I'll look at a picture of myself, you know, and I'll say, wow, you know, didn't really have a care in the world when I was in that picture, in that moment. You don't realize how lucky you are.
yeah, folks, if there's a message I want,
Take your time, Barry.
that I want you to take, it's how lucky you are and how lucky we all are. Yes, we have a lot of adversity, but there's so much good out there. And, you know, when I go for my treatments, you know, they're so nice and they all kind of know me. You know, I guess I have a little bit of a personality, you know, so I try and bring some encouragement, and they know I like to sit in a specific chair, and it's a chair that's by a sign that says, never give up. And whatever you're facing, folks, don't you ever give up. Don't you ever give up. Thank you, guys. I know I went a little long. God bless you. Sending you guys lots of love and appreciation. Thank you.
Thank you, Barry. That was awesome. And your knowledge, your data, and your transparency, you know, personally is wonderful. And it puts so much in perspective and also gives us so much to go out there and arm us with every day. Thank you.
Thank you. Thank you.
Thank you, Barry. Thea and team, thank you for working with Barry and NBS Highway and putting this on for us in the Engaged Speaker Series. Thank you to everyone that joined us today, and hopefully you took something from this, and especially, you know, what better way to end it than Barry's message about never giving up. We are in a challenging environment, but I think that the power of all of us working together and collaborating and sharing knowledge, and knowing that, you know, our end goal is to help people have home ownership and a great quality of life. We're all working on, you know, we're all pulling that same rope. So we pull it, you know, we pull on that rope together. And Barry, we can't thank you enough for being so vulnerable, but also spending the time with us, sharing your story, and just, again, being a great part of our family and being a great friend. So truly appreciate it.
Thank you, guys.
Thank you. Thanks, everybody.
Take care, everyone.